So each quarter, a large group of U.S. banks from all around the country, large and small banks, are sent a questionnaire, a survey, conducted by the Federal Reserve itself. The goal is to understand what's happening in our credit markets, the backbone of the U.S. financial system. Now, this is important. Realize there's no real-time metric or data source available to check how tight or loose credit is. Not really. It's all at the mercy of the banks. Theoretically, you could have a small bank in Des Moines, Iowa that's writing loans willy-nilly, while another bank in Midtown New York that's tightened lending standards up the wazoo, lending to only the most credit-worthy of customers. But in real time, there's no way to know. Not even the Fed knows. Hence why they conduct this quarterly survey. If the banks have tightened too much, the Fed's forced to cut the overnight rate right away. Because realize, the U.S. economy runs on credit. Business runs on credit. Without it, without debt, the whole thing collapses. Businesses stop growing. They stop hiring. They stop ordering product. Capital expenditures fizzle out. It all comes down to credit, lending and borrowing. Are the banks writing new loans? Are they extending enough credit? Is it easy enough to obtain a loan? This report looks at it all. And look, I read this report every quarter. I usually make a video about it, like this one. But something immediately caught my attention this time, because in yesterday's report, or Tuesday's report, it was the first time in 2 years the bank's liquidity concerns were mentioned in the Fed summary notes, mentioned over and over and over again. This is coming from the banks, folks. And I quote, "A major net shares of banks cited a less favorable or more uncertain economic outlook, worsening of industry-specific problems, a reduced tolerance for risk, or changes in accounting standards as important reasons for tightening lending standards again. In addition, a significant net share of banks cited deterioration in their current or expected liquidity positions. Also, decreased liquidity overall in the secondary market for C&I loans. C&I loans are commercial and industrial loans. That's the category for corporate lending. If you didn't follow that, in layman terms, the banks are screwed. The game is over. They aren't liquid enough. They won't be liquid enough, they're saying, especially the small regional banks with all that toxic CRE debt on their books. And this wasn't one or two banks, folks. This was like the majority of them.